Hey, welcome back to Stone Cold Investors. My name is Jesse, and today I'm going to be going over PayPal. Check out the description. I've got chapters and timestamps throughout the video, so if you're looking for specific content, feel free to go there and skip ahead to whatever you're looking for. All right, taking a look at the 5-year chart, we can see we started off at about 50, 60 bucks. Had a pretty strong, steady uptrend until about 2019 July, dipped, kind of did this double top right before the COVID crash, and then crashed down to about $80. 80 or 90 from about 120, and then we just ripped up, crazy momentum, hit 310, double topped, hit 310 again, and then started losing all of our averages and just downtrending for pretty significant amount. We're sitting about $97 right now, with recent lows at about 70. So let's go ahead and jump into the latest quarterly presentation now. All right, here we got the Q2 2022 investor update presentation. I'm just going to skim through this and kind of go over maybe a couple highlighted points here and there. All right, let's get into some different growth metrics here. We can see they had about 6% increase year over year of active accounts. Customer engagement was about a 12% increase. Total payment volume, TPV, was about 9%. Revenue, we had about 9 or 10% growth. 14% if you go by ex-eBay. Non-GAAP EPS, they saw a 19% decrease year over year. Included about 11 cents per share headwind from lower eBay transaction margin dollars and lapping. 11 cents being from credit loss reserves released in Q2 2021. 3-year transaction margin dollar CAGR of 12%. And then free cash flow, we had a 22% increase year over year, and it's about 19% of revenue. So I believe that's probably going to be their free cash flow margin is right around 19%. Then here we get a nice little visual of, what they had in 2015, 2019, and 2021. I'm not going to go through and read all of these out, but you can see we've had pretty steady growth throughout all of the metrics from 2015 to 2021. But of course, management is going to show this in their slide deck because it's kind of a sales pitch. So, but regardless, we've seen pretty healthy active account growth, free cash flow growth, payment volume growth. Basically, all those metrics have seen fairly steady growth from 2015 to 2021. Then they give us a couple slides just regarding kind of like the worldwide growth potential. Kind of what they're looking at doing to attract more international growth. And they go on to say, hey, PayPal consumer penetration across core developed markets remains below 50%. So they've got plenty of room in developed markets to grow. And we can kind of see these percentages laid out here. So there's room to grow, but there's going to be competition to grow into that room, of course. So trying to give us a sales pitch on kind of their future growth potential going forward. Then here we can kind of see another slide about their total payment volume growth year over year, about 9%. But then we get down into cross-border trade, and cross-border trade is actually down about 6%. So overall, total payment volume is growing. However, cross-border trade is actually compressing a little bit. And then we can see that their customer engagement is growing at about 12% over the last 2 years or so. So since Q1 2021, they've seen pretty steady customer engagement growth on the platform. Here we have revenue growth. Over the last 3-year period, it was about 16% CAGR or 22% excluding eBay. So top line growth has been looking pretty solid. And this last quarter, we see about 9% year over year growth in revenue. So looks like we had higher year over year growth at the beginning of Q1 2021, and we've kind of moderated down to around that 7 to 10% range. We see free cash flow growth, about 22% increase. And then they have a nice little slide here just showing their capital allocation between CapEx, stock repurchases, and then acquisition and strategic investment. So we can kind of see how they've been allocating their capital over the last 5 years or so. Then we get into fiscal year 22 guidance, and they're raising expected non-GAAP EPS to $3.87 to $3.97, expecting a net revenue about 27.85 billion, revenue growth 11%, and then free cash flow above 5 billion. They go on to give us a little bit of a guidance on Q3 22, so what to expect next quarter, and they're looking at estimated 6.8 billion revenue in Q3, which would give us about 12% revenue growth, with a non-GAAP EPS at 94 cents to 96 cents. And then it looks like we got just a bunch of financial information and supplementary information on the rest of it. So that is it for the Q2 presentation. Now let's jump into the valuation. Actually, before we go into the valuation, I just want to bring up one point. So we can see that like lately we've had a pretty decent run from PayPal. The stock price wise has gone from about high 60s to low 70s per share up to 97 fairly quickly, and most of it was on this news that Elliott, an activist investor, took a stake in PayPal. So I don't know how I feel about this. I mean, good things can come from activist investors getting involved and maybe changing the focus of the company a little bit more to improve efficiencies and guide them in the right direction. Especially Elliott has a lot of experience in kind of activist investing in tech companies, so it could be good, but the reaction with the stock price was pretty drastic, going from $70 to 97. And I think on the confirmation of the activist investment on Q2, the filings, it went up another like 10%, like 102, I think it topped out. So I don't know. They raised guidance as well, so that was a little bit of a good note, but just kind of makes me uneasy that we see that much stock movement from just the announcement of an activist investor. So we'll see what happens. It doesn't really change my valuation, but we'll see what happens going forward if it does actually end up helping the company a ton. All right, so first let's get into some historic numbers from the evaluation sheet. We can see that revenue growth has been about 14.14%. Average over the last 5 years. Gross profit or gross growth has been about 13.25%. Operating growth 14.45%. EBIT growth has been about 13.25%. Net growth has been about 18.36%, and free cash flow growth has been about 23.85%. So we can see that bottom line growth average over the last 5 years has been about 18.4%. So that's kind of like what we're looking at for historic 5-year growth numbers on the bottom line. We can see that they've been basically a steady grower over the last 10 years, fairly consistent. We'll see if we have any type of pullback from the kind of tailwinds that they experienced in 2020 and 2021. Maybe we moderate for a year before we start actually growing at a faster pace. Gross margins have been kind of moderating down from around 52% in 2012 down to about 43% right now. But their margins across free cash flow have remained pretty consistent. Starting off at about 18.62% free cash flow, ending at 19.62% free cash flow. So even though it's kind of ebbed and flowed here and there, their bottom line margins seem to be doing decently, other than, net margins is kind of off from those recent one-time expenses. Getting into return on capital, we can see that the ROC starting out in 2013 was about 12.6, and we're seeing it about 11.3 right now. So kind of similar to margins, kind of ebb and flowed, stayed pretty consistent. ROA has stayed pretty consistent, although it has regressed a little bit. ROE has kind of increased pretty drastically and then tailed off here. If we look at the historic bottom line yields on market cap, which is basically what the security is yielding on its total market cap, you can see free cash flow right now is about 4.5%. The 10-year treasury is sitting about 3.23. The EBIT is sitting at 2.24, and the net yield is sitting about 1.8. So free cash flow is above the risk-free rate, but the other metrics are below the risk-free rate. We can kind of see the same ebb and flow, cyclical moderation of yields compared to the risk-free rate over the last like 5-7 years. Shares outstanding has actually been decreasing pretty frequently or pretty regularly, so they've been a decent buyer back of stock, repurchaser of shares, and returning value to shareholders like that. We started out in 2013 about 1.22 billion, and we're at about 1.175 billion now. So small buybacks, but buybacks nonetheless. We can see their historic growth rates have kind of done the same cyclical action, starting off at about 51.99% for free cash flow, 22.75% for net growth, and we're sitting at around pretty low right now, 8.9% free cash flow growth and 0.79%. But if we look at 2021, we're probably going to be, or 2020, we're at 70% and 48% growth on those metrics. Going back to short-term quick load ratio and short-term operating cash flow to current liabilities. Quick ratio is sitting about 0.23. Short-term operating cash flow to current liabilities about 0.13, so not the best. We can see that there wasn't they didn't have any type of share price regression due to increased debt load or anything like that. Their enterprise value and their market cap has been fairly in line the entire time. If we look at their long-term debt, currently sitting at about 10 billion, short-term debt sitting at about 45 billion. They've only got about 4.5 billion on cash on hand. So they are pretty leveraged as far as the short-term and long-term debt that they hold compared to their short-term holdings of cash. So that's something to be a little bit cautious of. Okay, so now let's get into the valuation and some of my assumptions. I'm targeting a base CAGR of 15% with a 5% margin of safety, so target rate's 20% CAGR. We can see that the 10-year treasury on historic 5 years has been 1.99% dilution. They've been buying back slowly about 0.5%. Bottom line growth, they've had about 18% over the last 5 years average. On an average, their EBIT yield spread over the last 5 years has been about 0.12. So that's been a 0.12% deviation from the risk-free rate. The net yield spread has been negative 0.17 deviation from the risk-free rate, which is the 10-year treasury that I use. And the free cash flow yield spread has been about 0.66% compared to the risk-free rate. So if we look at the different risk-free rate scenarios I have between very bearish and very bullish over the next 5 years, I have 4.5% risk-free rate for very bearish and 1.5% for very bullish. Then kind of stagger down in between. Future estimates for dilution over the next 5 years was 1% dilution in the very bearish standpoint and about 1.5% average buybacks for very bullish. Bottom line growth, so this is going to be growth between those net income, EBIT, and free cash flow numbers. From a very bearish standpoint, we've got about 6% CAGR growth. Very bullish is about 18% CAGR growth, and just from going through the slide decks, we can see that they've done probably anywhere from like 12 to 22% growth, depending on the bottom line metric that you're looking at, whether it be free cash flow or net income. Then going over to the yield spread, so the higher the yield spread, the more discounted it is from the risk-free rate. So from a very bearish standpoint, my yield spreads across EBIT, net, and free cash flow are 2% or 2.03%, 2.4%, and 2.26% across those metrics. Going to the very bullish scenario, the EBIT yield spread is 0.12%, the net yield spread is 0, and the free cash flow yield spread is 0.66. So essentially that means that the market would be giving PayPal a multiple, that would say, you know, you're basically you're still growing and there's still a lot of runway for growth. So we only expect you to yield essentially the risk-free rate. And in this very bullish scenario, the risk-free rate is going to be 1.5%. So that's going to have a huge tailwind for multiple expansion across the valuation of the security. So based off of those numbers, we can kind of see that to get my 20% target KGAR, we're pretty much there through the very bullish and bullish scenarios. Strictly from a price standpoint, the 5-year target for the very bearish is $73.52. The target for the bearish scenario is $108.78. The target for the base case is $164.86. The target for the bullish case is $272.53. The target for the very bullish case is $547.35, which would be a pretty drastic outlier. Usually on a probability basis, my very bearish and very bullish scenarios have about a 5% probability. So I like to keep my high probability scenarios between usually my bearish and my base case, with a decent chance of the bullish case hitting. So very bearish is 5% probability, bearish is 25% probability, base case is 50% probability, bullish case is 15% probability, and very bullish case is 5% probability. So based off of all of these numbers, we can kind of see that in the very bullish and bullish scenarios, it's already at that 20% KGAR mark. We got 41% KGAR in the very bullish, but that's very, very, very low probability. We got about 22% KGAR in the bullish scenario, which is a little bit higher probability, 15%. But we're only at about 11.2% KGAR in the base case and 2.3% KGAR in the bearish case, and a negative KGAR over the next 5 years for the very bearish case. So typically I want to see at least green, at least my target being hit through the base case. If we look at that for PayPal, about $70 is getting us close. So ideally the accumulation zone for me personally, if I decided that I wanted to own this, and I was targeting a entry, would probably be between $65 and $70 based on my assumptions, my analysis, and the evaluation that I'm pulling off of it. So that would $65 to $70 would give me around that target 20% KGAR. But you know, if you're only targeting 10% return to 5% margin of safety, that's going to change a lot, right? So then you're probably looking at a base case target of around $80 instead of $65 or $70. So it just depends on your comfort with the industry, how confident you are in it. For me, I'd really like to see probably around 65 or 70 before I start adding more, or if I wanted to add more. And we know that the recent low was right around $70, $68 or $70. So there's a chance that it gets back down there. I'm kind of hesitant to really do anything. If anything, right now I would maybe offload some shares as we're running, just because the whole situation with the activist investors, like I don't know. I don't put that much of a value on it. So to me, the recent price movement that was heavily due to that is a lot of speculation that they're going to be able to turn it around. Maybe they will. I don't know. But I started accumulating my small position before I had these evaluation models down. So my cost basis was a little bit higher. So I'm looking at potentially trimming off some of those shares that were accumulated in the 90s, just building up cash and having a small position with more cash available to go a little bit heavier if we get back into that $65 to $70 range, which is really where the sweet spot is for my evaluation model. So I hope you guys enjoy the video. Feel free to like and subscribe if you want to see more of this content. I'm going to try to do one of these videos about once a week on a different company, maybe revisit a company every once in a while. So if that sounds good, like and subscribe, and we will catch you next time.